So the question is really, is this a strategic tweak before he steps down in April, potentially taking some of the pressure off whoever succeeds him? Or is this the beginning of what is going to be the exit of all central bank exits from a decade of easing?
Okay, well, yesterday's move is a tweak, and it was to ease the pressure, selling pressure of the 10-year bonds, which was distorting the yield curve, and this will restore the liquidity in the 10-year bond market. So it is a tweak, but it could be a first step towards the exit. And we have to see the development of the inflation rate and the GDP wage hike next year. But this is a sort of the positive development, I would say.
Ito-san, how positive of a signaling was it from Governor Kuroda? Or, I mean, how strong of a signaling to the markets? No matter what his real intentions are, whether this is a real exit or just a tweak in terms of technical adjustments, the fact that he also sort of eased by increasing asset purchases at the same time, is this enough to tell the markets, wait, don't get ahead of yourselves, this is not tightening? Because he continued to repeat that last night.
Yeah, in the Q&A session of the governor's press conference that he emphasized, he repeatedly saying this is not tightening, this is not tightening. And his reasoning is that if you look at the real interest rate, nominal interest rate minus inflation rate, that has been declining because inflation rate was going up. And raising nominal interest rate is just moving back to neutral in the real interest rate sense. So that part, I think he's right. And but he also denied this is not a step toward exit, and he's not preparing for any change in the monetary policy framework. That is probably not quite true. If you look at the so if you look at the inflation rate expectation for the next year, that has been steadily rising throughout this year. So looking ahead to 12 months from now, I think many private forecasters and also inside BOJ are catching up to the reality that inflation rate above 2% may stay. So in the recent past, BOJ was saying, no, inflation rate will decline next year because the cost push factors will disappear next year. But now we are seeing that there's hope that the demand side will be stimulated by a large wage hike, which is a response, partly response to the high inflation rate this year. So maybe next year we'll see a demand pull inflation and stabilize at 2%. Right. Then that is a foundation for the step toward exit.
Which is, that in itself, if that's what the BOJ's thinking is now, is a big change just in the last couple of months. And of course, Kuroda said last night that the forward guidance hasn't changed. They're still very wary of what does happen. Seems to me there's a potential for the new governor to be kind of left in a difficult position because the initial change in yield curve control has been made. The BOJ's concern about possible slowdown in inflation in the second half. What happens if U.S. goes into recession as the Fed keeps hiking rates so aggressively? Would that put the new governor position where no matter what Japanese inflation is doing right now, they can argue we still need stimulus? I think it could be tough.
Yes, so difficult position, I'm sure. And it's not only managing the inflation and GDP and unemployment and balancing between the financial stability and monetary policy, also relationship with the U.S., relationship with the government. I think a lot of factors are moving next year. And it'll be very interesting to see as a central bank watcher.
So Ito-san, why Why now? What's the rationale behind the timing? Because of all of the challenges Kathleen already mentioned, not to mention that we do have the Shunto wage negotiations coming in the spring. Why not leave this to the next governor, and why do it now when he only has 2 more meetings left?
So I think in the last few months, there has been a lot of challenge to this 25 basis point and selling pressure on the 10-year government bonds. And to keep the ceiling, BOJ had to buy a lot of JGBs. And the holding of the JGBs have been rising, accelerating in the recent months. And that distorted the yield curve. And there's a dip around 10-year bond. So I think they decided that this is not good for the market functioning of the bond market. So that's the timing. That's the decision for the timing.
Professor Ito, let's test another thing that's been bandied about in the last 24 hours, and that's, well, look at what happened. You know, just last week, Federal Reserve, Powell comes out very hawkish. Then, oh my gosh, on Friday, ECB, very hawkish. Clearly, Governor Kuroda had to react, had to do this. He doesn't call it a rate hike, but in fact, it is a bit of a rate hike when you move the top of the band for the 10-year JGB. How big of a factor has that been in their thinking?
It's not, I think, the direct spillover from the foreign central banks, ECB and the Federal Reserve, but through the market and bond investors, that if they think that the BOJ, the Japanese bond rate should rise, they, test that 25 basis point ceiling. So that's a market pressure, which is in response to the what's going on in the U.S. and ECB. But I think BOJ was looking at the market, not the foreign central banks.
Let's talk a little bit about the markets, because the global market reaction has been huge. How important are the actions of the BOJ for the functioning also of the global bond markets and the FX markets as well?
Right. So it was a surprise in the sense not many market forecasters were saying that tweak was coming. And that was exactly the moment that Governor Kuroda wanted to change the band. And so in a sense, surprise was necessary to change this band. And so I think in that sense, the first change in 10 years or more is big change for the investors' psychology and so on. So I'm a bit surprised how big the reaction in the yen and the Japanese stock prices. But I think that will, will be stabilized in a day or two, and investors start to digest the path from here to the next year. So it was a shock, but it wasn't necessary.
If the hurdle for an exit from this super expansionary program is really replacing cost push inflation with demand pull inflation, right. I'm wondering how the reopening of the Chinese economy, the potential rebound in the Chinese economy and Chinese demand plays into that global inflationary dynamic.
Yes, so the happy scenario, I would say, is dependent on the U.S. not falling into severe recession, and China will not fall into a severe recession or financial difficulties. And of course, those conditions are very important. And again, it will be data dependent that how the BOJ can follow the happy scenario.
So wrapping this up, is the gist of what you have told us, what you see, that if the inflation numbers continue to hold up, if inflation continues to hold next year at 2% or higher, that the leaning on the BOJ, once Kuroda leaves and with someone new in place, the leaning is to continue down this path of normalizing, after so many years, Japanese monetary policy, gradually withdrawing the extraordinary stimulus, and getting something, kind of going back to the future, a more what you would call standard kind of policy that will help keep the economy and the markets on track?
Simple answer is yes. I think any central bank wants to go to a normal position where the inflation rate is 2% and nominal wage rate rise at 3%, and interest rate above inflation rate. And this next year will be very crucial for Bank of Japan to step toward that new normal or old normal, I'm not sure. And it depends really on the wage increases so that people are happy to spend more, and that will move into the demand pull inflation when the supply side factors are disappearing.